All right. What is up, tycoons? What's up, traders? Super excited for today's video. Lots of amazing data that we're going to break down as always. And today's video is really going to focus on seasonality and looking at the pre-election and election year data and using that seasonal data, okay, to then combine that with some technical data and come up with a nice broad-based analysis. We're going to go over some of the data in the beginning of the video that's going to highlight maybe why we're starting to see this turn in the market and why I think in 2024 the S&P 500 index SPX will be around 5300. Now, it may come in a little bit higher, it may come in a little bit lower. But that's basically what I'm targeting for the S&P 500 in 2024. Now, to start the video off, we're going to take a look at US retail flows. We can see that we're seeing a huge increase here in single stocks. This is the rolling 20-day average. But if you look at it in monthly in billions, all right, we see ETFs here in orange, and then we have single stocks here in blue. And for both of these, we're at levels that we haven't seen since the bear market started, right? Back in January of 2022 is really when the last time we were at these levels for inflows of individual stocks, and then also for inflows of ETFs. We're back at levels that we really haven't seen since the beginning of the bear market. Now, there's a couple reasons why. Okay, one of them is going to be the wage growth tracker. This was something that Jerome Powell and the Fed was very worrisome about, and this was one of the things that they had a lot of fears about, was a wage price spiral. Now, we have not gotten that wage price spiral, and we've actually seen the wage growth tracker start to cool off here. Okay, so that's one of the reasons why the market has been reacting well here lately and going up. We also have PPI and CPI, basically inflation cooling off. The producer price index, all right, had its 12th straight monthly decline. Now, one thing to note is that being that we are looking at the peak of inflation was already over a year ago now, the rest of the CPI and PPI reports may not be as favorable on a year-over-year percentage change, being that they're going to be looking at a lower percentage from a year ago than, the peak, right? So you do have to keep that in mind. Now, today's video is sponsored by Simply Wall Street. There's a link in the description for a 14-day free trial and up to 40% off for the first 100 people that join and use it and, decide to purchase it. Now, there's really nothing to lose here, guys. I highly recommend using it. You get that 14-day free trial and you can cancel without it, but it's a really great, awesome website and app that I've used for a while. I'm glad to have them as a sponsor. Today's video, as always, is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. Now, take a look at some of this data right here. When the S&P 500 is down 25% or worse since 1950, and we take a look at the returns 1 year later, all right, almost every single time except during the '08 financial crisis, the market has been green. And the vast majority of the time, it's not green by a little bit, it's green by a lot, right? With the exception of right here in the 70s, 1974, and 2000s, right after the dot-com bubble. Okay, the market has posted phenomenal gains, right? We see here 31%, 32%, 43%, 14%, 56%. The S&P right now is roughly, let's just call it about 20% up on the year. And it may fall down back to about 15%, if we start to see some pullbacks, maybe even 10%, but we still have the other half of this year to go through, and the data is looking really good here. Okay, it averages out even with the off years to about 21.6%. Okay, and then you take a look in 3 years out, 5 years out, and 10 years out, the data is just super bullish. Okay, very bullish, and really interesting stuff. Now, you see very similar things here when you look at the NASDAQ. Okay, the NASDAQ reported 73% gains, 67% gains, 20%, 25, and 29%, with about a 24% average here if you include, during the dot-com crash and also the great financial crisis in '08. Those 2 years, the market was red. 1 year afterward, and even more shocking, 3-year out, 5-year out, and 10-year out gains So, a lot of people, are looking at this data, and this is data that people were looking at, when the S&P 500 was down so much and when it dropped, and had its huge decline. There's a lot of people in the background that are actually looking at this data and starting to invest, right? But this isn't what comes out at the headlines, right? When the S&P 500 is down 20%, you don't see people saying, "Oh, hey, you know, historically 1 year out, the returns look very good." No, what they tell you is that, hey, the S&P 500 has already dropped 20%, but we haven't even seen the real crash, and it's going to drop another 50%, right? Those are the headlines, and those are the type of videos and articles that you see, hear, and read about during those time periods. Now, Wall Street strategists stick to cautious equity view, okay? And if you take a look at their second half outlook implied by strategists' average year-end target, they do have lower year-end targets, right? And so we do want to talk about that a little bit, but we'll dive deeper into it in just a moment. Now, one reason maybe why we could be seeing a pullback in the market, and I've covered this several times in multiple videos, if you look at the July market performance in pre-election years, we've already reached this peak right here, okay? And this is your 10th trading day in the month of July. And this blue line here, the blue dotted line specifically, notice how all of these dotted lines, these are all of the pre-election years, and the solid lines are going to be, basically what the market has been done right now. But you can see that we start to see a decline, right? And we start to see a drop, a really big drop in tech specifically. And you see that the Dow Jones Industrial Average really tends to hold up the best out of all of these. But you start to see a strong pullback in the Russell 2000, 1000, the Nasdaq, and the S&P 500 towards that later half of July. And it seems like we are potentially getting that. Now, there's a lot of earnings coming soon. It's going to be a complete roller coaster, and this could change some of that data. But this is some of the seasonal data that, I spoke of we're going to be using. Now, when we take a look at the 4-year presidential cycles, okay, your post-election cycle is okay. All right, it's pretty average right here. Then you have your midterm cycle. All right, and we had a bearish midterm cycle this year. But this right here is basically right when the midterms start. Okay, and right when the midterms happen, is going to be that end of the year. Okay, which is also very close to when the S&P 500 bottomed. If we draw the line, it's more specifically right around here. But the S&P 500 bottomed basically right around the midterm elections, which was really, really interesting. And we've already had an amazingly bullish year so far. And again, this is that July, okay? This is that basically half of July, okay, right in the middle of the year time period. And you can see that the market actually does cool off, right? We see a nice pullback here, and then it rebounds, and then it pulls back again. And really, in the last quarter of the year is really when we start to see the market fire off again and go on some really, really big runs. Now, those runs continue into the election cycle year, okay? And we see the market continue to go up even more. So, based on the presidential election cycles, I do think that there's a strong chance that, we chop around and consolidate for, the next couple months, and we see a strong push in towards the end of the year. That continues and sustains throughout 2024, towards the end of the year of 2024. And throughout this time period is when we're going to be seeing the S&P 500 index around 5,000, maybe 5,300, maybe potentially even higher. I don't have an exact price target, okay, but 5,300 is kind of the area that I'm aiming for. Just another way to visualize some of this data. If you look at presidential election years throughout history and the calendar year performance during presidential election years of stocks and bonds, when a new president is elected at 9.3%. All presidential election years historically is at 11.3% returns, and the incumbent president wins. That's a 13.4% returns in the stock market. Bonds also see some decent returns here. The bond market has been very volatile. It's been more volatile than the stock market. I've mentioned that a few times, and that's largely due to the rapid rate that they increase the Fed fund rate. Now, this right here, if you take a look, S&P 500 index cumulative return since 1932, years with no election. All right, the subsequent 1-year return, 5.8%. But when you have those presidential election years, up 10.2%. Okay, so this is just more data, just showing you guys, these election years, they do tend to be really good for the market. And we're going to see if that will happen in 2024, and if some of that pre-election year data is also going to play out. And we see a strong push to close out the year that would lead us into the presidential election year, which historically since 1932 has returned about 10.2% in the S&P 500. Now, that was a lot of the seasonality data. Okay, what we're going to do here is, we're going to take a look at some technicals and some different technical signals, right? And we have the Kappa curve on here. That's going to be our indicator here. And essentially, once you see a round trip on the monthly Kappa curve, okay, where this line goes back above zero, so it made a round trip below and back above zero, the S&P 500 performance, all right, is historically bullish. All right. And that's essentially what this data set right here is going to be showing you guys. If you take a look 1 year out, all right, so 1 year out, the average return is going to be about 19.11%, and the median return is about 18%. And this is for the S&P 500 performance following the Dow Jones Industrial Average. Now, the Dow Jones Industrials are really a leading indicator for the economy. And so we're starting to see this flip here, and this is a good sign for the economy, essentially, in these markets. Now, it looks even more impressive 3 years later, 5 years later, 7 and 10 years later as well, right? Where, 5 years or about 7 years later, you're seeing over 100 and close to 200% gains in the S&P 500. Now, if you take a look at the monthly chart for the S&P 500 and you look and you see your PPO curve, now the PPO is your percentage price oscillator. It's a momentum oscillator that measures the difference between two moving averages as a percentage of the larger moving average. As with its cousin, the MACD, the PPO is shown with a signal line, a histogram, and a center line. The signals are generated with signal line crossovers, center line crossovers, and divergences. Because these signals are no different than those associated with MACD, we basically, there's not much difference between them, but the first difference, okay, is that PPO readings are not subject to the price level of the security, and the second is that PPO readings for different securities can be compared even when there are large differences in price. Now, what we're going to be looking at here is basically the round trip as well in the monthly chart for the SPX PPO. All right, this is a very bullish signal. If you see and take a look at the S&P 500 performance following a bullish monthly PPO cross, all right, again, very, very bullish data, especially 1 year out, 3 years out, and the further out you go. And we've really, we can see here about 6 months out, all right, the average is 7.4% with the median at 3.84%. So we'll see 6 months from now, what the market is going to be at, where it's going to be at. But, it's basically completely green. Okay. 1 month, 3 months, 6 months, every time period from 1 month out is green here. So that's what we're going to be looking for when you take a look at the averages, and we're going to see if that, trend will sustain and will continue. Now, this is the Sean trend meter here. All right. And, the Sean trend meter is definitely another indicator. And what we're seeing here is when we see similar round trips in the Sean trend meter, all right, which was developed by Tushar Sean, it assigns a numerical score to a stock or other security based on several different technical indicators covering 6 different time frames. Distilling all this technical information down into a single number provides an easy way to identify the strength of the trend for a given security. And so essentially what we're seeing here is that once we see similar round trips, again, in the S&P 500, 1 year later, 3 year, 5 year, the data looks very, very bullish with an average return of about 11.47% 1 year out, with the median here at 13.52%. This is the NASDAQ 100 monthly chart right here. Okay. And again, we're very close to getting that round trip in the NASDAQ monthly Kopik curve. All right. So we haven't crossed back above zero yet, but we're very close to it. And the returns there are very phenomenal as well. Looking 1 year out, 3 years out, again, you're just seeing that the average and the median returns are very green here. And these are very good signals. And I do think that we're going to be starting another, secular bull trend. We've been in this long-term secular bull trend that's going to last till about 2035, and we're going to see corrections in bear markets throughout that, throughout the next 10 to 12 years, but that's not going to, in my opinion, stop the overall much bigger picture long-term secular trend. Now, this right here is your NASDAQ 100 percentage of stocks above their 150-day simple moving average. All right. And so you can see that we came up to a level here we've reached many times in the past. And these are actually bullish signals, right? This is the NASDAQ composite down here. And you see it goes on a massive bull run. Then you see here, we get that same signal. We go on a massive bull run. Here, we get that signal, massive bull run. Here, we get that signal, massive bull run. Each one of the signals are indicated by the line right here, this vertical line. And those are really, really strong signals. And so if this is going to correlate, we could again see very, very positive returns in the NASDAQ. You take a look 1 year and 3 years out, 24% returns on the average, the median is 23%, with 3 years out, about almost 70% here at 68, and the median at 65%. And this is the NASDAQ 100 percentage of stocks above the 200-day simple moving average. And so if you take a look here, again, you're seeing those really, really positive returns in the market. 6 months out, 1 year out, 2 years, 3 years, 4 years, 5 years, seeing very, very favorable and preferable gains in the stock market and in the NASDAQ 100. Now, this is the NASDAQ 100 performance following 6 consecutive months below the weekly cloud, and then followed by 3 consecutive weeks above. And you can see, again, 1 year out, 3 year out, 5 year out, all of this data looks very, very good. And the longer and farther out you go in time, the larger the gains become as they compound on top of each other. This is the S&P 500 performance following a round trip in the NYSE weekly cloud. And we can see, again, very, very preferable gains, and gains that investors would want to see 1 year out, 3 years out, 5 years, 7, 10 years, and some realistic expectations, right? These are your maximum 1 year drawdowns. In 1985, you had a 4%. In 1988, you had a negative 5%. So, basically what we're doing is we're taking these time periods here. Okay. And what we're doing is we're looking at the max drawdown. Okay. And these are the, max drawdowns that we had during all of these bullish cycles, right? And during all of this bullish data set that we're presenting here. And you can see that, the most that went down was about 5.65%. So seeing a 5% correction is, normal and still would be healthy, and doesn't mean that we can't see these impressive 1 year average and median returns, followed by the larger 3 year, 5 year, 7 and 10 year returns as well. So, that's something to just keep in mind. You see the stock market, fall 3, 4, 5%. It doesn't have to mean the end of the world anymore these days. All right. Now, hopefully you enjoyed today's video. Smash that like button, subscribe to the channel if you did. Email me, zachleytrades@gmail.com, anytime if you guys want to do a one-on-one personal session. I do lots of coaching sessions, and we can work on getting a time scheduled that fits both of our schedules. And don't forget to check out today's sponsor, Simply Wall Street. I'm telling you guys, you won't regret it. All right. There's a completely free 14-day free trial for you guys, and up to 40% off using the link in the description for the first 100 people that get the membership. All right, it's a very affordable plan. If you get the yearly plan, plus the discount, that puts you at under $200 for the entire year. And that's it.